When identifying accumulation, manipulation, and distribution, AMD, on a chart, one key factor to consider is how trading sessions affect price movement. Each session brings different levels of activity, which can influence market behavior. For example, let's look at the euro-dollar on a 15-minute chart. During the Asian session, the price usually moves slowly because trading activity for the euro and dollar is limited. The market often remains in a small range, consolidating without making big moves. This period is quite important because it sets up the price action for what happens next. Now let's see what happens when the London session starts. The price suddenly moves up, engaging the liquidity above the consolidation range as well as the Asian high before getting back inside the range. This shows that manipulation occurs with the opening of the London session and the injection of volatility into the market. Finally, the price distributes lower on the opposite side of the manipulation move. The sequence we see here is Asian session consolidation, followed by manipulation when the London session opens, and then distribution as the price moves lower. By understanding how these phases work and combining them with your trading session, you can better predict price movements and spot trading opportunities. If you find it difficult to identify consolidation on the chart, you can use equal highs and lows as a similar concept. Let me show you how. First, make sure you have identified the overall directional bias and that you are trading in the direction of the bigger picture. If you're bullish, you only need to identify equal lows, which show that liquidity is gathered below this key area. Then, look for a liquidity run below this area. When the price returns inside the range, it confirms that this breakout was only manipulation. What usually follows is a continuation of the higher price movement, which is in line with the bigger picture. Now, the psychology behind this concept is that, in order for continuation movements to happen on the chart, the market needs to gather liquidity. This is because massive buyers need massive sellers present in the market. Manipulation happens until the market accumulates enough liquidity, after which we see the price movement we want. So, in this case, with a similar approach, we identify these areas as accumulation, manipulation, and distribution phases. Our goal is to trade the bulk of the movement, which happens after the manipulation confirmation.